Okay.
Good morning. The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is titled Implementing Basel III, What's the Fed's Endgame? Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes to give an opening statement. Federal banking regulators recently proposed several new rules to rewrite regulations in the financial system largely on a partisan basis. The proposed rule that would have the largest effect is a so-called Basel III Endgame proposal. That proposal is underdeveloped, misleadingly motivated, and written behind closed doors principally by the Fed's Vice Chair for Supervision as part of his holistic review. That proposal is being sold partly under the guise of implementing the Basel Committee on Banking Supervision's recommended Basel III framework, thereby outsourcing U.S. standards to an opaque global governance committee in Europe. But the proposal put forward goes far beyond those recommendations. It would put the U.S., unfortunately, ahead in a race to a gold-plated top for global capital requirements and push the U.S. to the bottom for global competitiveness. The proposal would install arbitrary and extreme increases in required capitalization for what regulators, Biden administration officials, and Fed stress tests have said is an already resilient, well-capitalized U.S. banking system. The proposal is partisan, as evidenced by the Fed and FDIC board votes and lack of consensus and unanimity among Fed governors and FDIC directors. Partisan rulemaking by Democrat-appointed federal banking regulators is a tacit admission that they are content surrendering independence of their agencies for short-term political gain. The Basel-related capital proposal lacks a convincing foundation, and it is cynical to put forward as a rationale for the non-credible evaluation of March banking instability authored and engineered solely by the Vice Chair for Supervision at the Fed. The proposal appears in many areas to simply be arbitrary and capricious. The proposal was put forward with shockingly little quantitative analysis of what the impacts will be, where the unintended consequences will be felt, and there is no substantive cost-benefit analysis. Members of this committee from both sides of the aisle asked for analysis from the Fed's Vice Chair of Supervision, yet the request was essentially ignored. The proposal also presents unexplored threats to capital markets, including markets for Treasury securities, and no one knows how the proposal will interact with other recent proposals by the regulators, with yet more seemingly on the horizon. In a time of historic inflation, the fastest increases in interest rates in modern history, and a growing likelihood of a credit crunch, now is not the time to raise capital levels. Such action threatens to further constrain credit availability and put already sensitive sectors, such as commercial real estate, in further peril. The proposal would be an effective repeal by rule writing of bipartisan congressional intent in the S-2155 tailoring law, a repeal that has been a partisan goal for some even before the March banking stresses and has essentially been instructed by President Biden. The Basel III Endgame proposal is just a start for Democrat-appointed federal bank regulators. Since that proposal was made in July, proposals for long-term debt and resolution plans have been put forward, which this subcommittee will consider in our next hearing. And we have heard that even more is in the pipeline, yet the regulators in charge will not directly tell Congress or the American people, and possibly even their fellow board members, of their plans. Federal banking regulation under the Biden administration has unnecessarily become divisive and partisan, which itself is an emerging threat to stability. The divisive, underdeveloped, and arbitrary recent Basel III Endgame proposal should be withdrawn and replaced with a proposal that focuses on addressing problems that exist and uses adequate input from the private sector, Congress, and robust impact and economic analysis. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Mr. Foster, for 4 minutes for an opening statement.
Thank you, Chair Barr, and thank you to our witnesses for joining us. Today we will discuss federal prudential regulators' joint proposals to implement the final components of Basel III agreements and modify capital calculations for U.S. global systemically important banks. These proposals modify capital requirements for the largest U.S. banks with the goal of ensuring that they appropriately account for the risk of their activities and hold the necessary assets in reserve to weather periods of significant stress in the financial system. The 2008 financial crisis and the subsequent taxpayer-funded bailout of banks and the long-lasting damage to the financial health of our country demonstrated the need for reforms to ensure the safety and soundness of the U.S. banking system. In the years that followed the financial crisis, Congress enacted the Dodd-Frank Act, and global regulators convened to develop what would become the Basel III framework, many facets of which have already been implemented. During the passage and implementation of Dodd-Frank and initial implementation phases of Basel III, many predicted that the higher capital requirements would damage the competitiveness of the banking industry in the United States. They predicted that the increased capital requirements, particularly focused on the largest U.S. banks, would make it hard for large U.S. banks to remain profitable and to compete against both their international competitors and against their smaller competitors in the United States. In practice, the exact opposite has proven true. These firms continue to lend at record levels and earn record profits and outcompete their foreign competitors in a stable and growing economy that followed those reforms. But as history has shown, threats to the financial system are dynamic, difficult to predict, and constantly evolving. Until recently, bank failures have been controlled and have not required bank regulators to utilize emergency measures to head off systemic risk and contagion in the banking system. In an age of rapid financial innovation, internet-driven bank runs, rising geopolitical tensions, pandemics, and climate change, regulators and Congress must respect the lessons learned from the financial crises of our past while also looking ahead, adjusting prudential standards as necessary to account for emerging risks. The proposals that we are discussing today are necessarily complex, totaling more than 1,100 pages. The details are important since they will undoubtedly have effects on the lending activity, market behavior, and internal operations, both of the large U.S. banks, which will be directly affected, and the other players in the economy who will have to adapt to a new equilibrium. Because of that complexity, it's important that the public have maximum visibility into both the rules themselves and to the quantitative consideration that led to the final choices made. For that reason, in July, I joined Chairman Andy Barr in sending a letter to the Federal Reserve Vice Chair for Supervision, also Barr, requiring details of the analysis and supporting data used to carry out the holistic review of capital requirements that led to the proposals we're discussing today. as well as, any other supporting data or key assumptions that have to be made. We must recognize that this is not a purely quantitative operation. The analyses of bank requirements, have important assumptions that have to be made regarding, the probability of financial failures for a given level of banking and the cost of those financial failures. Though it's unlikely those will be exactly calculable ever, but it's important the public see the key assumptions. And so the Federal Reserve's response to date has not included this information we ask for, and I urge them to be more forthcoming. And that said, I look forward to hearing the perspectives of our witnesses today, and thank you again, Chair Barr, for holding this hearing.
Thank you to the ranking member, and the chair now recognizes the chairman of the full committee, the gentleman from North Carolina, Chairman McHenry, for 1 minute.
Thank you, Chairman Barr. The Biden-appointed federal banking regulators had the opportunity to learn from the March banking instability. They had the chance to productively engage with Congress and propose reasonable changes to regulation to improve safety, soundness, and stability. Instead, they took advantage of a crisis to justify their long-held, politically motivated priorities. Members of this committee on both sides of the aisle have asked for the economic analysis to justify the Basel-related proposals. The Fed's vice chair for supervision has essentially ignored that request. We need to know how this will impact inflation, which accelerated in August. What about the Fed's rate policy? How does it affect that? Or credit availability? How does it affect that? Or the cost of credit? We need to answer these questions for the American people whose day-to-day lives will only get harder if this is implemented. That's why committee Republicans sent a letter this week calling on Biden's regulators to rescind this deeply flawed proposal. We need to see the economic analysis. The American people need to understand the justification, and we need to hold them accountable. I yield back.
Gentleman yields, and the chair now recognizes the ranking member of the committee, the gentlewoman from California, Mrs. Waters, for 1 minute.
Thank you very much. We certainly did receive a wake-up call this spring with the failures of Silicon Valley Bank, Signature Bank, and First Republic. It became clear that we need to improve safety and soundness rules for large banks given the systemic risks they can pose. To that end, regulators propose to strengthen bank capital requirements for the largest banks to ensure that, among other things, they hold sufficient capital for unrealized losses in their securities portfolios. I'm talking about the Federal Reserve, the Federal Deposit Insurance Corporation, the Office of the Comptroller of the Currency. They all are urging us to make sure that we do what is necessary to ensure the safety and soundness of our banks. Their proposal would also implement an international agreement that the United States made with other countries in 2017 that Trump's regulators ignored while they prioritized deregulating big banks that could put our economy at risk. Here's the bottom line. We need stronger rules, not deregulation, to avoid future crises. I yield back.
Gentlelady's time has expired, and today we welcome the testimony of Mr. Greg Baer. Mr. Baer is the Chief Executive Officer of the Bank Policy Institute. Mr. Robert Broeksmit. Mr. Broeksmit is the President and CEO of the Mortgage Bankers Association. Mr. Andrew Olmem, partner at Mayer Brown, and Ms. Alexa Philo. Ms. Philo is a senior policy analyst for banking, systemic risk, and economic justice and racial equity for Americans for Financial Reform. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Baer, you are now recognized for 5 minutes for your oral remarks.
Chairman Barr, Ranking Member Foster, members of the committee, thanks for the invitation today. Congressional attention here is important given the stakes for the U.S. economy. It is further warranted because the agency's proposal would constitute a de facto repeal of regulatory tailoring legislation that Congress passed on a bipartisan basis in 2018. Before getting to the details of the proposal, I'd like to dispel 3 misunderstandings that have arisen around it. First, some have suggested that it is a response to the failure of Silicon Valley Bank and a few others in March 2023. Those banks failed for 2 reasons: interest rate risk and liquidity risk. The proposed Basel rule has nothing to do with liquidity risk or interest rate risk. It is about everything else, credit risk, market risk, operational risk, counterparty credit risk, and risk on derivative instruments. It is apples and oranges, or apples and refrigerators. Second, some have suggested that this proposal is needed because bank capital models understated risk and caused the global financial crisis. In undisputed fact, no U.S. bank had adopted the internal models approach to capital assessment by 2008. The global financial crisis occurred on the watch of a Basel standardized approach. Remarkably, a standardized approach that this proposal will continue. Third, some believe that while significantly higher capital charges will push activity out of the banking system, there's no problem with that, as non-banks will pick up the slack. There are a lot of problems with that. Banks lend and intermediate at lower rates than non-banks, not because they are kinder or dumber, but rather because their deposit base gives them a lower cost and more stable source of funding. As a result, banks are the only reliable lenders during an economic downturn. I remember asking a fintech executive in March in 2020 how her firm had weathered the crisis. Her answer was, it was easy, we just stopped lending. Consistent with that, very recent research from the Bank for International Settlements found that non-financial firms cut lending by about 50% more than banks in the face of financial shocks. Turning to the proposal. The second half of the proposal is a series of formulas setting a risk weight for every bank loan or exposure, and the first half is a description of those formulas. What the proposal is oddly lacking is any explanation for how those risk weights were in fact derived. The proposal contains almost no analysis of the absolute or relative risk of the underlying assets or exposures. The absence of detailed historical analysis is incredible, given that the agencies possess a massive database of historical experience and have easy access to market data. In place of analysis, the agencies simply set the 2017 agreement negotiated by agency staff in Basel as a minimum requirement for U.S. banks. But that agreement is not a treaty, and it carries no legal weight in this country. Furthermore, it was adopted before the Federal Reserve began to impose a stress capital charge for many of the very same risks contained in the Basel Agreement. Most importantly, though, the proposal ignores reality. Since 2010, the nation's largest banks have weathered very large macroeconomic shocks and market turmoil, benefiting from diversification across both product and geographic lines. In contrast, the proposed rule implicitly finds that every large bank in this country is undercapitalized and requires on average 16% more capital. The proposed rule is calibrated at such a high level that it will be difficult to offer products that the Basel formulas and the Fed stress testers disfavor. Thus, and to an unprecedented extent in the history of this country, the decision of whether you get that loan and how it will be priced would be shifted from banks and their loan officers to the formula writers in Basel and the stress testers at the Federal Reserve. Lastly, I should note that while the agencies frequently refer to this as implementation of the Basel Agreement, the clear understanding at the time the Basel Agreement was announced in 2017 was that it would not increase capital for the covered banks and would probably decrease capital. This is completely inconsistent with that understanding. If the proposed rule were adopted, banks operating in the United States would be the only major banks in the world being assessed solely based on a standardized approach, would be the only banks in the world experiencing an explicit stress capital charge on top of that standardized charge, and would be the only banks in the world facing a variety of capital add-ons above the Basel agreed risk rates. And we don't know why. For any banks, and particularly for the regional banks, Congress specifically said should be exempt from this kind of treatment. Thank you for your time.
Thank you, Mr. Baer. And Mr. Broeksmit, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, I'm Bob Broeksmit, and I appreciate the opportunity to testify this morning on behalf of the Mortgage Bankers Association, the national association representing more than 2,200 member firms and an industry that employs 390,000 individuals and provides real estate finance-related services in virtually every community across our nation. My over 35 years of experience in real estate finance gives me a unique appreciation for the complexity of the housing finance system, as well as the importance of ensuring that it works for all participants. MBA believes that this NPR poses unwarranted risks to the U.S. economy, to housing and real estate markets specifically, and contradicts many of the Biden administration's policy goals. This includes efforts to close the racial homeownership and wealth gaps, the provision of affordable housing, the promotion of competition over consolidation, and the upcoming unveiling of a final Community Reinvestment Act rule. It is still unclear how the NPR interacts with other regulatory proposals and how these rules collectively could stunt economic growth and credit access needed to support the creation of more affordable housing from the largest providers of capital in the country. It is also unclear what specific problems the NPR is trying to solve, considering that the Federal Reserve and U.S. Treasury have consistently stated that the banking system is strong. For example, capital ratios of large banks operating in the U.S. have more than doubled since the Great Financial Crisis, and more than a decade of real-life experience has demonstrated that banks have adequate capital to withstand significant economic shocks. In fact, recent stress test results confirm that the banking system is safe and well-capitalized. The large increases in capital standards will likely stunt macroeconomic growth and reduce banks' participants as single-family and commercial multifamily lenders, servicers, and as providers of warehouse lines and mortgage servicing rights financing. The proposed changes effectively increase capital requirements at larger banks by about 15 to 20%, large enough to impact which lines of business banks choose to support or withdraw from. The proposal makes significant changes to how banks calculate their risk-weighted assets and imposes several additional requirements on banks with assets of $100 billion or more, including lowering the cap on regional banks' holdings of mortgage servicing rights to 10% of capital, less than 5 years after it was raised to 25% to encourage more banks to service mortgages. And under the proposal, get this, every $1 million of capital an impacted bank allocates to mortgage lending would translate to at least $7 million less lending to first-time homebuyers who can't come up with a 20% down payment. This, in turn, could cause banks to pull back even further from the mortgage business, making homeownership less attainable to first-time homebuyers and low and moderate income borrowers with smaller down payments. These borrowers overwhelmingly rely on low down payments to attain homeownership, and the proposed capital rule could discourage bank portfolio lending to these borrowers, driving all low down payment activity to the GSEs or government-insured and guaranteed programs. As a result, the proposed requirements could undercut the CRA and special purpose credit programs that leverage portfolio lending as strategies to close the racial homeownership and wealth gaps. The failure of the proposal to provide any credit whatsoever for private mortgage insurance effectively defeats the purpose of that insurance and significantly increases costs for homebuyers. A capital regime that recognizes the mitigation of credit risk provided by private mortgage insurance is not only far more efficient, but also reduces costs and improves affordability for first-time and underserved homebuyers who cannot make a 20% down payment. Given ongoing affordable housing challenges, regulators should be taking steps that encourage banks to better support real estate finance markets. This proposal does precisely the opposite, despite near record low single-family delinquencies and pristine underwriting. In conclusion, MBA strongly opposes certain provisions of the proposal that undermine the mortgage market and takes exception to the extremely scant economic analysis regarding how the changes will affect the economy, the single-family housing market, and commercial real estate finance markets. Thank you for the opportunity to testify this morning, and I look forward to answering your questions.
Thank you. Mr. Olmem, you're now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for the opportunity to discuss the recently proposed Basel III Endgame proposal. My testimony today is given in my personal capacity and is not on behalf of Mayor Brown or any of its clients. The Basel III Endgame proposal represents a major shift in bank regulatory policy. By design, the proposal will have substantial long-term consequences for American households, businesses, and the overall economy. Yet, the significance of the proposal is not only its economic impact. The proposal does not satisfy well-established, congressionally prescribed procedural requirements intended to ensure transparency, informed decision-making, and accountability. As if these errors are not problems enough, there's a more fundamental problem with the proposal. It disregards Congress's mandates governing capital requirements. The problematic nature of the proposal is particularly consequential because capital requirements are among the most important regulations in economic policy. They not only ensure that the banking system is safe and sound, but also influence the allocation of credit, determining if and on what terms credit is extended and by whom. Improperly calibrated capital requirements can undermine economic growth and potentially threaten the stability of the financial system. It is therefore critical that capital requirements are appropriately calibrated and durable. Yet, this proposal falls short on both accounts. First, the proposal fails to provide the data supporting its policy choices and prevents an effective notice and comment period. Under the Administrative Procedure Act, notice and comment is part of the process of formulating the rule. It is designed to provide an agency with valuable information from the public about how a rule could operate and its potential impact, so that the agency can then use the information to improve the rule. That's why it's hard to understand why the banking agencies omitted this supporting data. The public could have used the data to provide more informed comments and thereby help improve the rule. If the proposal is sound, the data will support it. If not, the proposal should be changed, as the APA requires. The proposal also provides inadequate information about its potential impacts, including on lending to consumers and small and medium-sized businesses. It also does not discuss whether it could trigger mergers or change the structure of the banking industry. The rush to complete this proposal has left key questions unanswered. It has also left the proposal vulnerable to legal challenges under the APA. In addition, the proposal disregards Congress's specific directive contained in both Dodd-Frank and the S-2155 that the Federal Reserve tailor capital requirements. The law clearly states that the Federal Reserve, and I quote, shall differentiate among companies based on the individual basis by category, taking into consideration their capital structure, riskiness, complexity, financial activity, size, and any other risk-based factors the board deems appropriate. Despite that clear language, the proposal embraces uniform capital requirements for all banking organizations with $100 billion or more in assets, and all but eliminates the prudential tailoring scheme adopted by the Fed just 4 years ago. In the entire 1,087-page proposal, tailoring is mentioned only in a single footnote. Uniform one-size-fits-all regulation may be easier for banking agencies to implement and enforce, but Congress recognized that it does not account for the diversity of bank business models that are essential to finance the U.S.'s $23 trillion economy. That's why Congress enacted tailoring mandates not in one, but in 2 statutes in just the last 13 years. If the banking agencies believe that the tailoring mandates impede their ability to craft appropriate capital standards, the constitutionally prescribed course is to request that Congress change the statute. Otherwise, tailoring and the APA remain the law of the land. It is the legal obligation of independent agencies to follow their statutory mandates established by this institution, not to selectively choose which to disregard. Going forward, what should be done to address this serious problem with the proposal? There is a common sense solution. For the Basel II Capital Accord, the banking agencies first issued an advance notice of proposed rulemaking. The banking agencies should now follow this precedent, using a revised proposal that complies with their statutory mandates. Proceeding first with an ANPR allows for more time for thoughtful analysis of the proposal's potential impacts. Analysis and the law should determine how the Basel Endgame proceeds. It's something we all should be able to agree upon. If Congress can help facilitate this prudent shift in approach, the country will be the better for it. Thank you.
Thank you. Ms. Philo, you are now recognized for 5 minutes to give your oral remarks.
Thank you very much. Good morning. Thank you, Chairman Barr, Ranking Member Foster, for the opportunity to testify, and thank you, Chairman McHenry and Ranking Member Waters. I am the Senior Policy Analyst on Banking and Systemic Risk at Americans for Financial Reform, a coalition-based organization dedicated to advocating for a financial sector that serves workers, communities, and the real economy, and for economic and racial justice. Before joining AFR, I worked at the Fed and in the banking industry on risk frameworks and regulatory adherence. I would like to talk about the importance for financial stability of the agencies following through on the capital proposals, the large bank proposal and the Fed's proposed rulemaking on this systemically important bank surcharge. These proposals will strengthen banks' ability to withstand stresses that can otherwise imperil banks' financial viability, hurt depositors and customers in the economy. Just 6 months ago, we were powerfully reminded of how important it is for banks to be well capitalized by the failures of SVB, First Republic, and Signature Bank, the second, third, and fourth largest banks to fail in this country. It is notable that all three were in the asset size band for which regulators had loosened guardrails in 2019. We continue to have a dangerous combination of, on the one hand, undercapitalization of some products, and on the other hand, compensation practices that incentivize outsized risk-taking. That puts all banks at greater risk of succumbing to contagion like that observed in March 2023. And as we learned, without the right standards, a bank can look well capitalized on paper, but still lack a sufficient capital cushion to weather severe stresses. These capital proposals take very important steps to address that. One important feature is that the Basel III Endgame finishes incorporating lessons from 2008. The megabanks' internal models fell short in the 2008 crisis. Regulators have placed limits on their use, but as former FDIC Chair Sheila Baer notes, the large banks are still relying on internal models that in some cases understate their risks and allow them to boost their returns. To address this, the Endgame requires reduced reliance on internal models and tells firms to make the transition to improved standardized approaches designed to be more risk sensitive. Another important feature incorporates lessons from 2023. The proposal restores Basel III requirements for banks in the same asset band as the ones that failed in 2023, removes an opt-out clause showing unrealized securities losses in regulatory capital for the same band and the band above it in total asset size. Without an opt-out clause, banks will need to be more transparent about the impact of unrealized securities losses on capital in a high interest rate environment. And supervisors, depositors, and investors will be able to more clearly appreciate the massive impact the underwater securities would have on capital. This capital proposal will put a stop to the opt-out that makes these securities losses less clear. Now, a main claim of those against the proposals is that higher capital standards reduce lending. We disagree. As FDIC Chair Grunberg noted and has been validated in studies, this is not the case. Equity capital is not locked away from supporting the real economy. Rather, it is deployed in numerous ways that benefit the bank, its stakeholders, and the economy. Also, more robust capital standards reduce the risk of financial crises, which research shows are longer and more damaging than other recessionary periods and have a disproportionate impact on Black and Latinx and likely, I believe, rural and other underserved communities. The issue is the bankers and bank lobbyists want lower and lower standards that make it easier for them to build up excessive risk positions, and they have compensation that incentivizes it. Lower capital standards also will enable more stock buybacks and dividends that also increase compensation. To sum up, the agency should move forward on these proposals. More well-capitalized banks are better able to provide credit to customers and communities, advancing economic justice, and helping the economy work for everyone. Thank you very much for the opportunity to testify today.
Thank you, and we will now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. And at the outset, let me offer, without objection to the record, a statement from the Financial Services Forum for the record. Without objection, that document will be submitted for the record. Let me start with Mr. Baer. I'm very concerned about the impact on mid-size and regional banks with the Basel III Endgame as proposed. Vice Chair Barr's de facto repeal of the bipartisan S-2155 undoes tailoring, conforming capital requirements for all banks above $100 billion, which will result in a barbell banking system. We'll have some community banks that are exempted from this proposal. We'll have too big to fail Wall Street banks, but the regional banking sector is really in the crosshairs here. And this will result, as I said, a barbell banking system, and it will eradicate the diversity that makes the U.S. banking system the envy of the world. Mr. Baer, please comment on the proposal's impact on the regional banking sector.
Sure, thank you. First, I would just note, regional banks now are actually well capitalized. Their challenge currently is actually an earnings challenge, especially at a time when deposit costs are rising and loan rates are not. And of course, this would add a massive cost to them. If you think about the proposal, under the Basel Agreement, they were supposed to benefit on credit because more granular risk weights would lower their credit charges. But here, the U.S. regulators have done add-ons, which they like to call gold plating to those. Regional banks will also see large operational risk charges. So they definitely come out net losers under this. And then more broadly on tailoring, even away from credit risk, they're subjected to a whole panoply of regulations that are not really fit for them. That includes detailed reporting on market risk, and they don't take a lot of market risk, resolution planning. Again, things where it's not the supplementary leverage ratio. Again, things that aren't really important substantively, but also come with a massive compliance burden. And of course, that's one reason Congress enacted 2155.
Thank you very much. And Mr. Olmem, I was very impressed with your testimony relating to the Administrative Procedures Act. I suspect that many lawyers are salivating at the arbitrary and capricious nature of this rulemaking. It was proposed with no meaningful public input or quantitative analysis or cost-benefit analysis. The Fed said it will begin collecting an onerous amount of data from banks after they release the NPR, and the agencies have indicated that the provisions in the rule may change over time as the agencies speak with the public sector. These are process failures, and they mean that the public does not have the data and final proposal to assess during the comment period to provide meaningful input on the proposal. Mr. Olmem, can you please touch on this, these many administrative law fouls? If the Fed was still molding the proposal and collecting data, shouldn't they have proposed an ANPR to allow industry experts to provide input?
Yeah, thank you for the question. And just to be clear, these aren't just technical process problems. These are statutory violations. The Administrative Procedures Act is federal law enacted by this institution to make sure that agencies, when they engage in rulemaking, have established a process that allows the public to engage and that requires agencies to act in an informed basis using the best available data so that an agency simply can't decide on its whim to take a particular action. It has to be reasoned and informed to help make sure there's good rulemaking in this country.
Thank you. And Mr. Broeksmit, I want to talk about commercial real estate. You talked about residential real estate. Let me talk about commercial real estate. I'm very concerned. We've got $1.5 trillion of commercial real estate loans coming due. Many of them are set at 3.5%. They're going to have to refinance at 7.5%, 8% because of higher interest rates. $5.5 trillion of commercial real estate debt is out there. About 50% of this is held by commercial banks. These loans were financed when rates were around zero. Even with regulatory phase-ins, we know that financial markets will be affected immediately by the onslaught of new and onerous regulations. Is now the time to undermine the ability of banks to lend and to intermediate in commercial real estate markets?
Chairman Barr, we're very concerned about the same issue, and it goes back to the issue that we've both discussed, or all three of us have discussed, about the lack of any underpinning, economic underpinning, not only to the rule itself, but how it interacts with other rules. You have another rule that is pending being made final for the Community Reinvestment Act that discourages banks from making multifamily loans for new apartments, for instance, and this will interact with that in a way that can really slow down our economy.
My time has expired, but I would hope that some of the political people at the White House would inform the Fed that they don't want a recession right before an election. The gentleman from Illinois, Mr. Foster, is now recognized.
Thank you, Mr. Chair. It seems like the rubber hits the road here with the risk weighting of assets. And there's sort of three general approaches. You can just allow the banks to use their in-house homebrew models, which are obviously open to gaming. If you suggest standardization but simple rules, then the objection you get is, oh, it's just a one-size-fits-all that doesn't really reflect the idiosyncrasies of our particular bank. And then if you adopt complex, standardized but complex things, then people say, oh, it's too long, it's too complex. Okay, so, how do you view the trade-offs between those three? Just to get started, do you think that directionally it's a good thing to move away from in-house modeling of these risks? Is there anyone that thinks that that is a mistake to move away from in-house modeling? Mr. Baer?
Yes, I mean, by the way, I think that was a terrific summary of why capital regulation is very difficult. It actually involves all the trade-offs you mentioned, and it's not easy. And so while we're critical, we understand this is not a simple matter. But it's interesting, if you talk about the Basel Accord, on credit risk, the entire purpose of the Basel Accord in 2017 was to preserve the use of bank models. That was its core. And as Europe and the UK have implemented, they have continued to use bank models. The idea was that you would allow banks to use models, but then there would be a floor to how low the risk weight could be produced. And they set that floor at 72.5% after a lot of haggling. So basically, your internal risk models can't show less than 72.5% of what a standardized charge would do. That seemed like a pretty good compromise. I would also note, bank internal models used in the United States, which is only really the largest banks under what's called the advanced approaches, they're back-tested constantly. They're back-tested by compliance staff, risk staff, audit staff, and most importantly, by federal examiners. We've been doing this for quite some time. We've not seen enforcement actions for gaming or misstating. Research that one of my colleagues here and another PhD economist did showed that there's actually no evidence that there are significant deviations among banks when it comes to modeling whether a credit is investment grade or not. So it is odd
I'd
that
like
they are
to
dispensing with that.
spread out the answers a little bit, because it's my memory that the internal risk models failed pretty spectacularly back in 2008. Ms. Philo, do you want to comment on internal risk modeling?
You bet. Internal models have been a primary focus of the proposal for a reason. There has indeed been substantial variation, and the variation is a tremendous challenge to be able to interpret and have a level of transparency around the models. In model land, there's something called assumptions, limitations, and weaknesses. And assumptions in particular, if you have good oversight, your assumptions, will be robust. And yet, I think the industry at large, those assumptions, limitations, and weaknesses is something they're all progressing on. And I think we have to have the appropriate humility. So I believe the internal models have been a substantial problem coming out of the 2008 crisis, and I believe this proposal is essential to remedy that.
Okay, and then what about the complexity issue? I don't think there's any way to write a brief rule here that really reflects the big variety of bank business models. And are there any comments on that? Are your objections mainly to the details of what's in this complex, and you wish this coefficient were different, and that there were better data behind the coefficient? Or do you have problems with the whole approach of a complex thing that really reacts differently to different businesses?
Ranking Member Foster, I wanted to go back to your original question about the three ways one could do this. And I think the Basel III risk weights for mortgages has that right mix, right? It's based on loan to value, and clearly a loan with a bigger down payment is less risky than a loan with a smaller down payment, and that's what the Basel III recommendations recommend.
No,
but then
that's loan to value at origination?
Yes.
Okay, because obviously the risk of a half paid off mortgage is a whole lot smaller.
yes, but
And
it's
so I don't believe, that's, for example, a complexity that you could add to this that would reflect the evolving risk of a mortgage as it gets paid off.
well, which would lower the capital requirements as equity improved. Of course, we would be happy if that were a part of it. What I'm saying is that I think they hit the middle ground, but then the regulators gold-plated it by 20 percentage points, and it's just not warranted.
What I'd add there is this is why there needs to be more data. This is as you know, capital requirements are very complex, and there needs to be a very robust process. I would note also that the Basel II process took several years. There was an ANPR, multiple proposals. My testimony contains a whole list of all the hearings that this committee did over several years.
Gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Baer, the federal Basel III regulators conducted an impact study.
Yeah, I mean, The discussion of costs and benefits in the proposal is extremely cursory, contains no data, does not include potential overlaps between that rule and other rules, including most notably the Fed stress test. I think everyone in academia and regulation understands, I think contrary to some other testimony, that there are costs to raising capital. In fact, the whole reason the regulators want a countercyclical capital buffer is because they know that when you raise capital, that diminishes economic activity. In past crises, the regulators have relaxed capital standards explicitly to increase growth. The Basel Committee estimated is that every 1 percentage point increase in capital requirements reduces annual GDP by 16 basis points, which means that this proposal would permanently reduce U.S. GDP by $67 billion a year. That's the Basel Committee of which these regulators are a part. There's uniform agreement on this in academia. The tough thing, of course, is trading off that diminishment in GDP with any reduction in the risk of the banking system and a reduction in financial stability risk. But this proposal does not do that weighing at all. It's a benefit analysis.
Okay, so they did a cost-benefit analysis?
There is no rigor whatsoever. I believe they state sort of conclusory, I think it's maybe a couple of paragraphs, maybe a couple of pages, but basically say, we've thought about it and we believe that the benefits exceed the cost. But there are no numbers attached to that.
Wow. I was going to ask you for the impacts, and you've talked about some of the impacts already. After the dramatic failure of the bank supervision related to Silicon Valley, might it be more beneficial to reform the bank supervision than to promulgate new capital rules? In other words, for the bank supervisors to clean up their own house first?
Well, I mean, I think part of it was a failure of supervision and not incidentally bank management. But again, this was a liquidity problem, and a depositor concentration problem. If you think about it, you never used to ask, do all my depositors know each other? Well, at Silicon Valley, they were all in the same text chain. That's not something other banks do. That is not a difficult problem to solve. I think other banks have demonstrated that actually their depositors don't know each other. They're in different industries in different parts of the country. I think that should have been the initial focus for how to fix this. There's some very smart things you can do around ensuring that banks are prepared to borrow at the discount window and that the regulators or that the Fed is prepared to lend. There are a whole series of smart things you could do here to make the system safer. But the answer to a liquidity crisis at a bank that had a unique balance sheet, is not to say, Truist needs to hold more capital for its mortgage loans, or J.P. Morgan needs to hold more capital for its market making. It doesn't have anything to do with that. So there's nothing holistic about this. This is not a tailored or smart response to what happened in March 2023.
Thank you very much. And I had a couple other questions, but you answered them in the context of the other one. So, Mr. Chairman, I thank you for the time and yield back.
Thank you. The gentleman yields, and now the gentlewoman from California, Ms. Waters, is recognized.
Thank you very much. I will address my first question to Ms. Philo. While big banks and Republicans complain that this proposal to strengthen capital requirements will stop lending and crush the economy, I think it is very important we put their critiques into perspective. To start with, Ms. Philo, isn't it true that this proposal does not apply to community banks at all? It only applies to large banks with more than $100 billion in assets, or those with extensive Wall Street-like trading operations?
Correct. Thank you, Congresswoman Waters. It does not impact community banks, and the preponderance of the impacts are on the largest banks, those banks who have relied most on internal models in the past, and also in the realm of operational risk, where they've had substantial operational incidents in their past. Community banks are not impacted, and as we know, community banks are essential for making sure lending is available through the life cycle for some of the most vulnerable communities in our country.
Ms. Philo, while we have heard some say capital was not an issue with the regional bank failures earlier this year, we had a Republican witness at an earlier hearing affirm that capital was part of the problem. with Silicon Valley Bank's failure, specifically relating to available for sale securities for regional banks. As I recall it, there was a run on Silicon Valley Bank, and that run occurred when they had to sell off their securities portfolio at a big discount, and they went to the market looking for capital, and that's when everything broke out and investors began to understand. So capital, or the lack of, did play a role in that failure, wouldn't you say, Ms. Philo?
Yes, I do. I believe that that a critical factor here was you had a certain amount of capital, but there was a lack of transparency how the underwater securities would impact that capital. And investors, when faced with uncertainty and a lack of transparency, all of a sudden that capital cushion or that confidence capital cushion really, frankly, may not be enough. And we certainly learned that in 2008. And I think there are corollaries here in the SVB context in terms of how the investors reacted to the level of capital once they knew about those and were face to face with the realized losses. Thank you.
I asked Margaret Taylor, a partner at Davis Polk, about this when she testified before the committee in May, and she explained that, quote, "I also think that the not passing through AOCI in capital, which is something that has been on the books since 2013, should be revisited," end quote. So, going further, indeed, the Fed found that there was a $1.9 billion capital shortcoming, or nearly 2% of its capital, when Silicon Valley Bank was able to have the unrealized losses in their securities portfolio exempted from its capital requirements. This is an issue that would be addressed in this proposal. Fed Chair Barr explained, and I quote, "If the bank had already been required to include those losses in its reported capital, it is less likely that the market and depositors would have reacted the same way. Furthermore, banks that were required to reflect unrealized losses on available for sale securities in regulatory capital manage their interest rate risk more carefully, suggesting that the requirement to include gains and losses on available for sale securities in regulatory capital leads to stronger risk management as well." Ms. Philo, we heard testimony from others today that capital was not an issue with the failure of Silicon Valley Bank, but do you agree with me? Again, we need to reiterate that capital clearly was an issue, and we need to strengthen capital requirements for our largest banks given the risk that they pose.
I do believe that capital was an issue, and it will potentially remain an issue for that band of total assets. SVB was a highly vulnerable firm in ways that SVB's board of directors, senior management, and Federal Reserve supervisors failed to act on. And one reason for that was a lack of true transparency around the precise level of their capital.
The gentlelady's time has expired.
Thank you.
The gentleman from Missouri, the chairman emeritus of this subcommittee and the current chairman of the National Security Subcommittee, Mr. Luke DeMeyer, is now recognized.
Thank you, Mr. Chairman. Thank the witnesses for being here this morning. You know, we've had testimony from the regulators as well as the bankers involved in the March banking crisis that we had, and it would appear to me that the regulators are probably as much to blame as the banks. The banks had a model, all of them had business models outside the norm, and were allowed to continue that outside the norm business model by the regulators, who quite frankly admitted in front of us that they didn't do their job. So now it looks to me like we have the regulators say, well, don't ever let, the old adage of never let a crisis go to waste. It looks like we're sitting here now, the regulators, who should be, finding a way to clean up their own act, are now using this as a way to institute a Basel, which is, to me, it's something we shouldn't be concerned about. But Mr. Baer, why is it a good idea to implement Basel III standards, which are European standards on our American banks and our American banking industry? I see you chuckle because you're like me, this is nonsense.
Well, I mean, there is a notion that, there should be international comedy, that's ITY, not EDY, with respect to capital standards. So it's not a bad notion to go off and talk about it and try to get banks more or less around the world on
Wouldn't it be a
some
better
footing.
idea for the European banks to actually follow our models because we've got one of the biggest and best financial markets in the world, and that we want to turn it around and use a failed model of the European banks, which are all bankrupt and government takeovers basically at this point?
Yeah. I mean, I think the worst of this is that the agency staff, not even at the board level, went over and negotiated this, but then have, again, continually added it on and implemented it here in a way that's not fit for purpose. To me, the best example of that is whether it's operational risk, particularly market risk. While Basel was considering all of this, the Federal Reserve implemented a global market shock and a stress capital buffer to cover those risks. Then, over the years, they negotiated in Basel a second way to cover that. And every other country in the world, I believe, is going to implement the one in Basel, and we're going to implement both. So, in terms of holistic reviews, you can think about Basel as a good place to start, but that does not relieve the agencies of the obligation to document the risk weights, to prove, and maybe things have changed since 2017, to prove where they got the risk weights, why they think this is appropriate, and then to consider what else they're doing and how it relates.
Okay, Mr. Olmem, it would seem to me that by implementing this, it would send a message that their stress tests are inadequate to actually be able to do the job of predicting a problem, understanding how a situation could be resolved, understanding how strong a bank may be. If you're going to have to jump up the capital ratios here, it looks to me like it's a testimony to the fact that stress tests aren't working. How would you comment on that?
Yeah, one of the interesting things about the proposal is it doesn't reflect all the other work that's been done over more than a decade. Starting with Dodd-Frank, which I think at the time was sold as the kind of final chapter in bank regulation, and yet since then we've had a whole series of additional pile-ons on regulation. And so I think a common sense way to think about this is, when is enough enough? And is it the reaction to every time a bank fails, which happens in commerce, it's capitalism, that we go on and have another wholesale revision of capital requirements?
You mentioned the tailoring situation, and we've discussed it, the chairman discussed it. It would appear to me that if we're going to basically repeal S-2155 and replace it with this one size fits all, that the small banks are going to be the losers in this. Would you comment on that?
I think that's one of the big concerns here, is that there's a remarkable diversity of institutions that are covered by this, and you're going to have a one-size-fits-all approach to regulating them, that over time the risk is we'll converge business models because that's easier to regulate, and losing that diversity in business models really does undermine the vitality of our banking system.
Thank you for that. Mr. Broeksmit, you made a comment that for every $1 million worth of capital increase, we lose $7 million of lending ability. And I think Mr. Barr mentioned that this is going to cost $67 billion in GDP per year. Have you got a cost of what it would be for the home mortgage market? What the cost is going to be to the consumers, to the banks, to the lenders?
The cost to consumers is that there'll be fewer sources of mortgage financing, and that mortgage servicing rights, which this proposal caps at 10% instead of 25%, will go down in value, and that affects the price of every loan, regardless of whether it's made by a bank covered by this proposal or anyone.
And that's going to really hurt the low and moderate income folks because of the increased cost of a loan.
That's correct.
Gentleman's time has expired. The gentleman from California, Mr. Sherman, is recognized.
Mr. Bauer is right to point out that increasing capital is not free. It does reduce economic activity. But having capital standards that are too low is very expensive. Just this year, we saw 3 banks go under. This was not a matter of just a liquidity problem. These banks were bankrupt, and the proof is the FDIC sold them for a negative $30 billion. So the market looked at their assets and liabilities and said they were vastly underwater. The cost to our system is not just the $30 billion that will be recovered in effect from depositors over coming years, but the lack of confidence, particularly in regional and community banks, that are still impacting our economy and will for years to come. Banks face two types of risks: credit risk and interest rate risk. The risk that the borrower won't pay, or the risk that the borrower will pay, but at a lower interest rate than the bank at an interest rate that's too low given then current economic conditions and the bank's cost of capital. We have a tendency to fight the last war. France relied on fixed fortifications, and we saw blitzkrieg. 2008 was about a credit risk. So now we have Basel III. But 2023 was about interest rate risk. And while Mr. Barr says Basel III does nothing, he's only mostly right. It does way too little with regard to interest rate risk. And there's this myth, and I fear Jay Powell buys into it, that if interest rates go up, the banks will be fine because although the loans they've made and their portfolios have declined in value, their depositors will be lazy and stupid and leave the money in low-interest bank accounts. And I don't think that a financial system based on the idea that depositors will be lazy and stupid over the long term is a sound basis for regulating banks. One thing that needs to be pointed out is that when you focus on credit risk, you take money away from local business loans and the construction loans that we need to build more apartment buildings because the rents are too damn high. When you fail to focus on interest rate risk, you incentivize the banks putting their money in 10-year treasuries, 30-year treasuries, highly rated. You know, Apple can borrow all the money it needs. So a system that underrates the risk of investing in lending money to Apple on a fixed rate 20, 30-year basis and overstates the risk of making loans to people building apartment buildings and building small businesses in my district is a perverse system. Now, we do something under Basel III in the available for sale securities. If they go down in value, that portion of the interest rate risk is captured. But what about those that are supposed to be held for maturity? What about just the basic loan portfolio that is in securities? Basel III is helpful in saying we're not going to rely on the bank's own internal modeling, but that's only as good as the new modeling that the regulators come up with, and let's see what they do. I'm particularly interested, Ms. Philo, in that the risk weight capitals on tax equity investments, where the bank buys the tax credit from the project developer, will increase from 100% to 400% for many banks. Tax equity investments can help low-income housing. That won't be affected. But under this rule, clean energy tax equity investments would face a four-fold increase under the proposal. Ms. Philo, what effect could that have on our ability to meet the standards of the Inflation Reduction Act, meet our requirements under climate change treaties?
I do appreciate where you're coming from. Different risks, have different weights, and we're relying on the regulators in this process to make sure that they align. I think this is one area where we may wish to see more of that. And may I say that I agree.
On behalf of polar bears everywhere, yes. I want to go on to one other question. Mr. Broeksmit, I'm told that we're going to have no credit for mortgage insurance. Does that make any sense?
Nonsense. It makes no sense at all. We should encourage banks to use other sources of loss-absorbing capital in our marketplace, and this gives no credit for private mortgage insurance.
Thank you.
Gentleman's time has expired. The gentleman from Texas, Mr. Williams, the chairman of the Small Business Committee, is recognized.
Thank you, Mr. Chairman. As we have discussed at length today, the Federal Reserve unveiled the Basel III Endgame proposal that changes capital requirements for financial institutions. Multiple regulators, including Chairman Powell, have come before this committee and testified that our banking system is already well capitalized and resilient. This proposal is using the bank failures from earlier this year as a weak justification for this partisan rewrite of bank capital regulations without considering their impact. These proposed changes will dramatically affect the banking community, and there is a legitimate concern that Basel revisions will have a broad impact on small businesses' ability to access reliable credit and increase businesses' overall borrowing costs. Over the past year, we've seen 2% drop in large banks lending to small businesses. Should regulators move forward with the Basel proposal, that number will continue to increase. So, Mr. Baer, question. Could you elaborate on how the Basel III proposal will impact bank lending and the cost of credit for borrowers? And what does this mean for small businesses trying to obtain a loan? I'm a small business owner. I'm interested in hearing.
Sure, thank you. First, I would say it's already having an effect. If you listen to earnings calls this quarter, you hear about banks already, particularly regional banks, talking about risk-weighted asset optimization, which means basically shedding the assets that have the higher risk weights. There is already a credit crunch beginning in this country. One oddity of the proposal is there's basically 100% risk weight for corporate loans. There's the possibility of a 65% risk weight to the extent that the bank's internal process rates those as investment grade. There is then a requirement in the Basel Accord that those also have to be listed on a securities exchange in order to get the lower risk weight. Europe, and I believe the UK, did not adopt that. Our research shows that it's an entirely spurious requirement, that if you look at the actual data, and we have a lot of historical data on this, internally rated investment grade loans do just as well whether the company is listed or not. So there's really no basis for that. But more importantly, we also have data, through the advanced approaches on what the appropriate risk weight really is. And it is more like 38% for corporate loans, closer to 30% for investment grade. So, this proposal has us debating between 65 and 100%, but the real answer is probably closer to 35%. It's just another example of where there is not data in this proposal to justify the risk weights that were agreed to at Basel, and another example of where they have taken the Basel Accord and implemented it in a way that's uniquely harsh on American businesses.
Okay, thank you. The Biden administration's out-of-control government spending has led to record high inflation and increased interest rates, which has made it extremely hard for Americans to buy a home. Now, under this administration, U.S. mortgage rates have shot up above 7%, and are the highest they've been in 22 years. Basel III proposal will worsen mortgage markets and reduce mortgage availability. Now, banks will be forced to be more cautious when extending credit, making the dream of home ownership for many families to become more and more distant. So, Mr. Broeksmit, can you elaborate on the effects that Basel III will have on the mortgage market, and will we see heightened consequences in an already struggling market out there?
Yes, we will. And the reason is that if these increased capital requirements go into effect, banks will make fewer mortgage loans, and or they will raise the price at which they're able to make those loans, because they still have to return an appropriate level of return on capital to their shareholders. So there'll be fewer loans available, less choice, higher cost, and the servicing aspect of this will also raise prices on consumers, because the mortgage servicing value is an integral part of how every mortgage is priced, not just mortgages made by these banks.
My last question is, federal regulators have made U.S. banking standards much more stringent than the standards European regulators are imposing on European banks. And we've heard this. The U.S. should not be pressured, let alone forced, by our own regulators to constrain American banks. This proposal is creating an unlevel playing field with financial institutions and constraining U.S. G-SIBs. The gap between U.S. and European capital levels will continue to grow, and the consequences of these decisions will drive adverse and unwelcome challenges to market access and the availability of credit. So in the time I've got, Mr. Olmem, can you expand on if the Basel standards will create a competitive advantage for European banks? And what will the effects of the European advantage be on the American public and U.S. competitiveness on the world stage?
Thank you for the question, and that's certainly one of the key questions that is left unanswered by this proposal. There's no real discussion of that competitive difference or study. I would just note from kind of a geopolitical interest is U.S. banks provide a really valuable role in the U.S. in the global financial system, and having them be active participants around the globe is good for the world's economy. This proposal does contain a series of charges that will make it more costly for them to be active in those markets, and I think that the long-term implications should need further study.
Thank you. I yield back.
The gentleman from New York, The ranking member of the Foreign Affairs Committee, Mr. Meeks, is now recognized.
Thank you, Mr. Chair. Let me pick up somewhat where my colleague just left off. You know, I'm very concerned about home ownership. And I know from talking to the NAACP and the National Urban League that they were very excited about the special purpose credit programs. Mr. Broeksmit, could you provide more background on what the special purpose credit programs is, and will this be affected at all by the Basel III Endgame?
It's good to see you, Mr. Meeks, and I'd be happy to elaborate on this. The special purpose credit programs permit lenders to craft programs that make it easier for groups that have historically been disadvantaged in the home buying and home financing process to get loans. They can be based on majority-minority areas, or they can be based on the characteristics of the individual borrower. Many banks have been very innovative in using SPCPs to tailor programs geared toward reducing the racial homeownership gap, which in turn reduces the racial wealth gap. This proposal increases the amount of capital that banks would have to retain on loans with less than 20% down very significantly, like by 40%. And that's where my earlier comment came in about for every $1 million in capital that a bank allocates to mortgages, they could make $7 million less in mortgages with that amount of capital. So the availability of those programs will go down and or the rates will go up.
Thank you. And let me, as indicated, I'm the ranking member also on the Foreign Affairs Committee. And I do understand the intent of Basel III Endgame was to improve the comparability of the capital levels across institutions and jurisdictions, which makes sense to me because I believe in that mission and I know how important the cross-Atlantic harmonization is, especially because of how interconnected. And I think that's the reason why, in response to some, how interconnected European economies are with the United States, whether we like it or not. What happens here affects Europe, what happens in Europe affects here, so there needs to be that interconnectedness. So the goal is harmonization to the degree that it would be possible. Now, I'm told by some that our nation's proposed implementation of Basel III goes in a different direction than that of Europe. Is that correct, Mr. Baer?
Yes, Congressman, I couldn't agree more. I mean, again, starting from the place that when the agreement was announced in 2017, the expectation is the capital wouldn't go up. In this country, it's going to go up 16%. Starting with, well, no, I guess that wouldn't be starting. Second, with the idea on credit risk was to retain internal models subject to an output floor or some parameters. This will be the only country I'm aware of that's eliminating those. And again, the biggest difference is, these other nations are not having a stress capital charge on top of this to cover many of the same risks. And we also still in this country have a gold-plated, which is, again, political parlance for higher, G-SIB surcharge, which really affects, it's really although they call it a G-SIB surcharge, it's really a capital markets surcharge because that's what all the components add up to. So this will be the only country that has not only the higher market risk capital in the Basel proposal, but also a separate surcharge that covers many of the same risks. We just put out some research on this the last couple of months. So we are deviating significantly from what was agreed and how it has been implemented in both Europe and the UK, and we are deviating every time upward.
And that affects competitiveness?
I mean, certainly it affects competitiveness. I mean, not in every area. I mean, U.S. mortgage lenders don't compete with French mortgage lenders. The competitiveness is more around capital markets. The bigger problem is that we're just wrong, that our calibration is too high, and whether we are competing with a European or a Japanese or a British bank, it just means that U.S. businesses and homeowners are going to pay more for credit than they ought to, and that more of what has traditionally been a banking business will leak out to the non-bank sector, where again, people will pay more, and where the government is going to have to intervene more frequently because they are not equipped and motivated to continue lending in crisis. That's the real concern.
All right, I have 15 seconds, so no one could answer my question, but I'll just say I have concerns also to see whether or not the Basel III Endgame would affect money going to MDIs and CDFIs, another issue which is very important to me. Out of time, I yield back.
Thank you, Mr. Meeks. And the gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you, Chairman Barr, and thank you to our witnesses for taking time to be with us today. Mr. Olmem, the Basel proposal is expected to increase the risk-weighted assets for banks' capital markets activities by 75%, meaning that banks will have a significantly higher capital charge for critical capital markets activities that they conduct. One such activity that could be adversely impacted, in my opinion, is securitization. Do you have any concern that Basel could negatively impact securitization in our economy and our capital markets?
Yeah, thank you for that question. That's a particular area actually where the U.S. proposal differs significantly from the European, and there's not a factual foundation to understand why the calculations involved there have changed. I would also just note generally about the economic analysis around the capital risk is that in the proposal itself, it says that the impact on liquidity of the proposal is an area that requires further research. That's the extent of the economic analysis that's contained in the proposal.
Thank you. I appreciate that. And Mr. Olmem, the Federal Reserve Governor Michelle Bowman has expressed concerns about the rolling back of regulatory tailoring provisions in the proposed rule, stating that, quote, collapsing capital categories 2, 3, and 4 into a single prudential category may call into question whether the Federal Reserve is complying with the statutory requirements to tailor prudential requirements for large firms, unquote. Are you worried that the lack of tailoring will drive consolidation among regional banks to achieve the scale needed for compliance?
I think this is a serious issue, again, that has not been addressed. And it's a common sense question that one would ask is one would put together a proposal like this. But again, there's no thorough analysis of that issue in the proposal.
I agree. Mr. Olmem, do you feel that the lack of differentiation in capital rules across such a wide range of banks is appropriate?
Yes, and more importantly, this institution has passed, again, in 2 separate bills over the last 13 years, legislation saying that tailoring is important. And that's why it's so striking to see an independent agency whose charge is to implement, not create, but implement the policy that this institution and this committee devises. Instead, here you have a clear example of where the institution is disregarding a clear directive from Congress.
Thank you. Mr. Broeksmit, home affordability is such a present problem due to various decisions, in my opinion, by this administration. This new proposal seems like it would make it even more difficult to purchase a home, particularly for first-time home buyers and borrowers who haven't yet saved up 20% for a down payment and are trying to get a conventional loan. Do you think this proposal will make home affordability worse, and if so, how?
Thank you, Representative Rose, and thank you for your leadership on the trigger lead issue, which we appreciate very much. Yes, as I've mentioned before, I do think that this will make mortgages even less affordable at a time when mortgage rates are at a generational high and when the supply of homes is very low and therefore home prices keep on marching upward. So it's exactly the wrong time to do this, and there is no evidence that the additional capital requirements in this proposal have anything to do with the underlying risk of the loans themselves. And that's what the regulators should be focused on, and there's no evidence at all that they have done that.
And what do you say to the regulators to fix these unforeseen, albeit obvious, downstream issues from this proposal?
The Basel III standards, which vary by loan to value, meaning that you are allowed to hold less capital against a loan where the borrower made a higher down payment, are sensible. The additional 20 percentage points that the regulators are putting on top of them are nonsensical. So on the mortgage side, if you simply went with the Basel III rules, you would have a much better result.
And Mr. Baer, in the seconds, it'll take all the time, but I'll let you answer this for the record. The Basel III Endgame proposal seems as if it could negatively impact the housing market in an already difficult time, and frankly, make commercial banking's incentive to stay in residential lending even less desirable. If your members start shrinking their residential lending businesses, what does that do to this housing market and to the GSEs? And I'm sorry we're out of time, so I'll have to let you answer that for the record. Thank you. I'll yield back.
The time has expired. The gentleman can answer that for the record. The gentleman from Georgia, Mr. Scott, is now recognized.
Thank you, Mr. Chairman. Mr. Barr, let me start with you. Now, you recall prior to the 2008 financial crisis, our nation's largest banks were over-reliant on their own models for credit risk. And these models failed to predict the magnitude of credit losses during the collapse. And this is why our Financial Services Committee put strong capital requirements into Dodd-Frank to strengthen the banking industry's ability to withstand stresses and shocks. And since then, our banking system has successfully navigated very difficult periods, including the recent 2020 COVID economic shock. But now, I'm very concerned with the unintended economic consequences of this proposed rule and its potential impact on our banking institutions as they engage in critical market activities. And there was considerable dissent and opposition for releasing the notice of rulemaking, including coming from Fed Chair Powell himself. On June 17, Chairman Powell raised concerns that the cost of higher capital could diminish banks' roles as financial intermediaries and liquidity providers in critical markets. And Chairman Powell even said this. He voiced concerns with the scope of the proposal. He said, and I quote, exceeding what is required by Basel, while also exceeding what we know of our plans for the implementation by other large jurisdictions. And he specifically referenced the EU and the UK. And Chairman Powell went on. He noted, and I quote, the need to strengthen supervision for firms with assets between $100 billion and $250 billion by tailoring these rules to reflect the size and risk of these institutions. So, my question to you is, this proposed rule eliminates tailoring rules under Section 165 of Dodd-Frank, which requires that the Federal Reserve, and I quote, shall differentiate among companies on an individual basis or by category. Now, my question to you, Mr. Baer, is why is it important to consider things like risk and size and business models and complexities of individual institutions? And what do you have to say in reference to my good friend, Chairman Powell's opposition to this rule?
Well, I'm not sure. It's a great question, and I appreciate it. I'm not sure he opposed it. I think I would characterize it as expressing misgivings, but he can speak for himself on that. And, you know, clearly, I mean, you can think about the rule proposal as whole or parts. In whole, it's raising capital requirements by 16% and effectively finding that every large bank in this country is undercapitalized, and there's no evidence for that. At the component levels, it also raises individual concerns, which I think the chair and other governors raised, like, why are we raising market risk capital by 75% when that's an area, again, completely away from Silicon Valley Bank, where banks are continuing to lower risk and still earn good returns, right? We have not talked at all about operational risk. If this thing was implemented, 30% of the risk-weighted assets held by banks would be operational risk assets. Those are phantom assets. They're not assets. They're just assets created to produce a capital charge. They're supposed to be about cyber attacks. They're really about litigation judgments. But the notion that 30% of the capital being held by the U.S. banks would be for a future fine that one of these same regulators might impose upon them seems distinctly odd, particularly when you realize how much that's going to cost borrowers. So right now you pay a judgment that costs your shareholders, but in the future it's going to cost all your customers because you're going to have to capitalize that. Widely disproportionate. And then, that's true for all banks, but certainly for the regional banks, they are really in a tough fight right now. They do not need this layer of burden on top of the other challenges they're facing.
The gentleman's time has expired.
Thank you very much.
Let you go a little longer because that was good testimony. The gentleman from South Carolina, Mr. Timmons, is now recognized.
Thank you, Mr. Chairman, and I want to thank all the witnesses for being here today. I feel like we're watching the same show over and over again, but somehow expect it to end differently. Everyone wants a prosperous economy. I think we can all agree to that. We want it to be stable, and we want to be well prepared to navigate the inevitably turbulent waters. But the left, time and time again, enacts they're well-intentioned policies, but they have no basis in the real world and ultimately do more harm than good, and it happens again and again. This happened pre-2008, again in 2023 with SVB and Signature, and here we are again pushing overly burdensome reforms that will again do more harm than good. So we're going to highlight the last three examples. Let's go back to pre-2008. Democrats strongly encourage banks to loan money to people regardless of their credit scores or ability to repay those loans. Doing so would be allegedly discriminatory. The Financial Crisis Inquiry Commission, which was appointed by Congress to determine the causes of the subprime mortgage crisis, found that federal housing policy either was primarily the cause of, or at the very least was a substantial contributing factor to the crisis. Mr. Olmem, you were on the Hill during that time. Would you agree that federal housing policy was a substantial contributing factor to the 2008 housing crisis?
Yes, and I think all studies back that conclusion up.
Okay. And this resulted in millions of Americans suffering severe hardship. People lost their jobs, people lost their houses. They couldn't buy houses they'd been planning to buy. So let's go to SVB and Signature Bank. Well, Mr. Olmem, do you agree that Congress spending $7 trillion resulted in inflation, which then resulted in increased interest rates?
A little bit outside my area of expertise, but I think again, most economists would say that it had something to do with it.
Okay, and just want to point out that if you were saving up for a $300,000 house in my district, you were expecting to pay around $1,100 or $1,200 a month in a mortgage payment. Now, because of interest rates going up, because my colleagues across the aisle spent $5 trillion, ostensibly because of COVID, that same mortgage is now about $2,400, $2,500. So they've essentially denied the dream of homeownership to the very people that they're allegedly trying to help. So here we are now discussing proposals to harden the economy to make it more capable of overcoming turbulent economic waters to solve a problem that was created by policies in Washington. So they spent trillions of dollars. They caused inflation to go up, interest rates rose, and SVB and Signature Bank failed. So, Mr. Olmem, would you agree that but for the increased interest rates that affected the long-term treasuries that SVB and Signature Bank held, do you think but for interest rates going more than double, would SVB and Signature have failed?
It's always difficult to do the counterfactual, but it is clear that the sharp increase in interest rates was a driving factor in the failure of that institution.
They grew too fast, and they had to park some money somewhere, and they parked it somewhere that didn't work because they got upside down with their treasuries. So now they are proposing structural changes to harden the financial system of the United States because the policies that we pushed out, I keep saying we, I was against all of these, that they pushed out caused the problem. So now they're going to solve it. So policies that were pushed out by Democrats created the problem, And we need to have these new policies that will further impede Americans' ability to get mortgages, will further impede the economy's ability to grow. So I guess, Mr. Olmem, do you agree that if all of these Basel III is actually fully implemented, will it be harder for Americans to get a loan, or will it be easier?
Well, so first of all, that's one of the reasons why this process is so problematic, is we don't really know, and the agencies are moving forward in an uninformed manner. They have not gone off and done that data to answer those basic questions. Now, I think you've heard from the testimony today, based on what we do know, the high probability is yes.
Well, you know, I think we've seen this show again and again. And before the Democrats spent trillions of dollars, Obama's Treasury Secretary, Larry Summers, said, this is going to cause inflation. And here we are today saying that these proposed changes to our financial system will make it harder for Americans to get mortgages, will make it harder for the U.S. economy to grow. And we need to stop causing problems. The federal government needs to get out of the way. And with that, Mr. Chairman, I yield back.
Gentleman yields. The gentleman from Illinois, Mr. Caston, is now recognized.
Thank you, Mr. Chairman. I'd like to follow up on a little more detail on the comments Mr. Sherman raised about tax equity markets. I know it's familiar to you guys. For some of my colleagues, this is where somebody who does something that entitles them to federal tax incentives but doesn't have taxable income finds a partner, typically a bank, who has taxable income, and they essentially buy the tax credit by buying a minority of the equity in the project in exchange for the preponderance of the tax attributes. Under the current rules, bank capital that is spent on tax equity only has a 100% risk weighting unless it's more than 10% of bank capital, at which point it takes on a 400% risk weighting. The proposed rules in Basel would essentially take off the 10% cap, oddly and perhaps accidentally, except for tax equity and low-income housing. I want to park that for a moment. But what that means practically, particularly in the way of the Inflation Reduction Act, which was primarily a tax incentive bill, is that here we have this huge investment, tons of investments of private capital, and every bank in this space is going to see a 400% increase in their capital requirements if they're providing tax equity. Mr. Baer, I see you nodding your head on this. So let me start with you, but first, Mr. Chair, I'd like unanimous consent to introduce a letter from the American Council on Renewable Energy, dated August 22nd, to the White House into the record. Hearing no objection, this letter says that these changes could lead to annual tax equity investments in the clean energy sector could shrink by 80 to 90%, and many banks could exit the renewable tax equity market entirely if this is implemented. Mr. Baer, do you agree with that statement? What are you seeing from your members as far as these tax equity consequences?
Thanks. I mean, first, I'll just say that was a better summary of the issue than I could have done, so I'm glad you did it for me. No, we've talked to banks. They would absolutely exit this market if their risk weight went from 100 to 400%. And the problem is even broader, which is we don't know why they decided to go from 100 to 400%. They obviously left it at 100% for low-income housing tax credits, okay? But why not these? Why not others?
Well, let me stay on that, because you're anticipating my next question. I don't understand that logic, because if I read the proposal, it says that, well, I guess let's first just back up. Do you believe that the risk profile of bank capital that is in tax equity investments for low-income housing tax equity is substantially different than the risk profile for other bank capital that's in tax equity investments?
Yeah, I mean, our understanding is that the loss experience, which again is what should drive capital rules, not the political favorability of the asset, the loss experience with both of these has been very good and does not justify a 400% risk weight, which is, four times what you would have for basically a corporate loan. So I don't believe that there's evidence that the loss rates on this are higher than any corporate loan you would make.
Okay, I mean,
Certainly there's nothing in the proposal that demonstrates that.
Yeah, I mean, I think they refer to in Basel III, I think they refer to the low-income housing investments as community development investments, not subject to the 400% tax.
Correct.
So would you have any objection to just saying, well, let's just say that these tax equity investments in renewable energy are also community development investments? They predominantly do help local communities, after all.
Well, I mean, what I would say is that the Basel Agreement is not a treaty that the Senate ratified or that this Congress passed as a law, so you can do whatever you want. I mean, you don't need to sidestep, the vernacular of the Basel Accord. You can do whatever you think is the right thing to do based on the risk and the cost.
Yeah, I mean, I'm inclined to agree, and just speculating, I'm not sure this wasn't an oversight on their part. The U.S. does some weird things to incentivize behaviors through the tax code that other governments don't do, and I could forgive European regulators for not necessarily appreciating all this, but I would hope that we can fix this in some other fashion. I hope maybe some of our colleagues could work with us, because we did really pass the biggest clean energy bill ever passed by any government in history anywhere. We are really seeing these huge investments coming in. We do really have to leave a better planet for our children than the one we inherited from our parents. We've got the tools to do it, and we shouldn't handicap it because of what I agree with you is no difference in the fundamental risk. And to be clear, I think it's important for our banks to be well capitalized. But on this narrow point, if we agree that the risk profile isn't different, then let's not cut off our nose to spite our face. Thank you all, and I'm out of time. Yield back.
Gentleman yields. Gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman. We are all in agreement that SVB's collapse was largely due to the failure of its leadership to manage the historical rate hike not seen in a couple of decades. And on top of the bank's mismanagement, the Fed's own review blames its supervisors for failing to act in a timely manner. And in my home state of California, we're still dealing with the ripple effects of the SVB failure. So instead of venturing into new capital requirements that will increase financing costs for small businesses and first-time home buyers, federal financial regulators should follow their own reports and address their mishaps and supervisory breakdowns. So, Mr. Baer, SVB purchased long-term debt to the point where it had breached its interest rate risk limits on and off since 2017. And so in your point of view, who is responsible for allowing the limit breach to happen? And who bears the responsibility for giving SVB a break for breaching these limits?
Sure, thank you. It's an important question. I mean, clearly the primary responsibility lies with the management of the bank. And, a secondary, I think, would be the examiners who tolerated the breaches.
Would you say it's the San Francisco Fed?
Yes, I believe that is correct.
Yeah. Then do you know if San Francisco Fed was the only reserve bank allowing their members' banks to purchase long-term T-bills?
Well, I mean, it was more the duration than the nature of the instrument. So if you think about what was really happening, it was a perfect storm in the sense that all banks around the country, as a result of COVID and stimulus programs, got in massive amounts of deposits. Usually when you're getting in lots of deposits, you're also having a lot of loan demand, so you take those deposits, you make loans. There was not loan demand, again, because of a lot of programs and the way the economy was, so they had tons of deposits and they needed to put it somewhere, so they bought securities. The smarter banks, most of the banks really probably in all the other reserve districts, they said, well, you know what, we're going to buy securities, but we're going to buy short-dated instruments because interest rates could rise, right? And a lot of the banks, and I talked to them, when they had their earnings calls, they got grief from analysts, investors, saying, why are you earning such a low yield? And what they responded responsibly was, I'm managing my interest rate risk, and I want to keep my duration short because rates could rise. SVB and some other banks, not many, took a very different tack, and they said, no, we're going to stretch for the yield. We're going to buy longer dated instruments, and that's what ended up dooming them when there was a run. Again, if there had not been a run, they would never have had to realize the unrealized losses, but there was, and there was not a good way to monetize.
So simply put, SVB's collapse is being used as a red herring to increase capital requirements. So federal financial regulators have the tools, but they decided not to use them. So according to a recent 10,000 small businesses survey, 70% of small businesses reported it was difficult to access capital. I want to ask you another question, Mr. Baer. Several groups wrote a letter to Fed, OCC, FDIC, asking these three agencies to delay the Financial Community Reinvestment Act rules until after the capital rules are finalized. So if federal agencies proceed with their timelines, can you describe how these layers of new regulations could impact access to capital for small businesses and financing for consumers?
I think this is a classic example of what a holistic review would look like, in the sense that, The CRA proposal, it's in some ways similar to this in that it's incredibly detailed and effectively a form of credit allocation, but it assumes where banks will make certain investments and how easy those investments are to make. Of course, that is now driven by a subsequent proposal, on capital of over 1,000 pages. And I will confess, we have not even mapped out this CRA credit for this. How reasonable a business is that to be in now? So, I think a lot of this would be in the mortgage market. So, for certain types of loans, is CRA incentivizing something that the Basel proposal is disincentivizing? I don't know yet, but I'd love a chance to think about it and then comment on the CRA thing.
Let's move on, because I know my time is coming to an end quickly. But I will also want to echo the comments that we heard from my colleagues about the proposal that will make it even harder for lenders to offer loans to buyers who do not put down the 20% down payment. We're talking about low-income families, the veterans, much of the Americans of all different backgrounds to buy a home to live their American dream. So can you talk about what type of homeowners will be pushed out of the market?
Yes, I agree with you that first-time home buyers who do not have generational wealth and don't have the ability to make a 20% down payment will be affected most by this, and that's the very area where banks are being creative in loans on their balance sheet, and they should be encouraged, instead of having massive surcharges to the capital they have to allocate on those loans.
Thank you.
The gentlelady's time has expired. The gentlewoman from Massachusetts, Ms. Presley, is now recognized.
Thank you. Earlier this year, we witnessed 3 of the largest bank failures in U.S. history. Direct consequence of Republican deregulation in 2018, which weakened bank regulations by exempting banks like SVB from enhanced stress testing and stringent capital requirements. As has been proven, the Republicans' opposition to regulation comes at the expense of economic stability for working families. And now they are doubling down on their prior mistakes, despite the harm that we saw just a few months ago ripple across our economy, especially in my district, the Massachusetts 7th. When SVB collapsed, small businesses in my district couldn't accept payments. Affordable housing development was slowed. That was suddenly in jeopardy. And tech companies couldn't make payroll. Ms. Philo, when banks lack sufficient capital, who bears the brunt of the cost when there is a financial crisis?
Thank you very much, Congressman Presley. Research shows that financial crises are hugely costly and have a disproportionate impact on Black and Brown communities, Black and Latinx communities, and businesses, and rural and other underserved communities. The 2008 crisis cost $2.6 trillion, and the set of capital reforms in these proposals are really essential to prevent that large-scale boom and bust of financial cycles that we've found ourselves historically, and that hurt all Americans and businesses, but disproportionately reduce the wealth and the access to credit for communities of color, rural, and other underserved communities and businesses. Thank you.
No, thank you. And adding insult to injury, and we've seen this happen time and time again, SVB's CEO was paid millions of dollars ostensibly for being incompetent, rewarded for the harm that they caused. And every time banking regulators try to increase capital requirements, we hear this misleading corporate rhetoric like that of Jamie Dimon, who said that these proposed capital requirements are bad for America. And I'm really quite tired of it. So let's set the record straight here today. Ms. Philo, isn't it true that better capitalized banks are able to lend more even during periods of stress?
Thank you very much. Yes, a bank can use capital to make more loans. Many bank executives in the bank lobby claim that increased capital requirements will undermine credit availability. We strongly disagree that increased capital requirements will undermine credit availability. Indeed, well-capitalized and secure banks are essential to providing credit to businesses, families, and communities. A 2020 World Bank report summarized several studies that found that well-capitalized banks in the U.S. had higher loan growth than nearby banks with fewer capital reserves, that well-capitalized large U.S. banks had higher loan originations and liquidity, and that better capitalized international banks had lower funding costs that enabled them to increase lending. I recognize there are studies that say a lot of different things, but I found this to be credible, and I appreciate the time.
And similarly, some banks believe that this rule will slow down the U.S. economy, but do you believe that this will be the case given that implementation will be gradual and occur over years?
I recognize the question, and yet I do believe that these proposals will not slow down the economy. Their proposals make the long implementation and the gradual phase-in explicit, and I believe that that is the intention there, to mitigate those impacts. So I do not believe that it will be an overarching issue.
Thank you. The benefits of higher capital requirements are clear. They will enhance bank resilience and secure more stable lending in our economy. We've seen 3 bank failures this year, and this rule is necessary to strengthen our financial system so that it can weather future crises. The American people are paying close attention. Republicans continue to oppose common sense regulations in our banking industry. We know who will suffer, and we know exactly who to hold accountable. Thank you. I yield.
Gentlelady yields back. Chairman Barr has allowed me to sit in on the chair briefly, so I'm going to recognize myself for 5 minutes. Thank you all for being here today. The interagency proposed rule for implementation of Basel III regulatory framework would add up to 20 percentage points to internationally agreed upon Basel III risk weights for mortgages. I don't want to be redundant. I know that we've kind of explored this area many times this morning. I was fortunate enough on the break that we just had to meet with Wisconsin realtors and Wisconsin bankers back-to-back in some roundtables. And I thought the conversation was actually fascinating. There's obviously an issue that has emerged in this economy, which is adults 25 to 35 years old have been completely frozen out of the market for the most part. And some of this came from feedback we were getting from some of the realtors. Some of them also happen to be mortgage brokers. I was wondering, first of all, Mr. Broeksmit, can you talk a little bit about this issue related to credit scores for consumers and this whole group of adults in that age range that have no credit score, is what we're being told at this point, or you know, if they end up being in a situation where they're a married couple where one may have a credit score and the other one doesn't, so they're making changes and going through all these gyrations to try and put themselves in a place so they could qualify for a mortgage. So they're first-time home builders.
So one of the things about credit scoring that is frustrating is that most credit scores don't give credit for your rental payment history. There is nothing more predictive of your future ability to make a housing payment than how you're paying it today, whether it's an apartment or whether it's a home. So there are efforts underway to get landlords to report that payment history to the bureaus, and there are also workarounds, although they are cumbersome, as I'm sure your constituents told you, so that you can get credit for that rental experience. For instance, if you can get 12 monthly bank statements and it shows that amount going out about the same time every month, that is a big consideration in underwriting. So there are some steps underway to ameliorate that for credit scoring.
Yeah, and the proposal, also related to small business, as they continue to see credit lines, there's these unused portions of credit that are out there. And some banks right now have this discretion to simply cancel those credit lines and then try and reissue. I'm wondering if you wanted to comment on that, because it's kind of a confusing part of, once again, what most small businesses in America are looking at as they try and capitalize some of these new projects or purchases.
Well, if I understand this voluminous proposal correctly, banks would be required to hold capital on the maximum amount that could be drawn rather than the amount that is outstanding. That could have a really chilling effect on the sort of small business credit you mentioned, and also home equity lines of credit, where consumers take that out and use it as they need it because they only pay interest if they use it. And then if the banks are forced to hold capital against the whole line, it would make it much more expensive.
Yeah, I think the numbers were, it's like 70% of small businesses right now in America are saying they're having a very difficult time accessing credit, which is up considerably from where it was even a year ago. What effect do you think it would have on the FICO scores for small business owners as well, which I know is part of the mix right now as you talk to many of the banks kind of across the country?
I think the main effect is that the cost of the credit and the availability of the credit the cost would go up and the availability would diminish. If the business owner or the consumer makes timely payments on that credit, I think the credit score would be okay. It's really more a question of the availability and the cost.
Yeah, the final thing I would just add is, and I'm not sure, Mr. Barr, you talked about the credit crunch, I think is the way you described it before. If you see some of the banks kind of tighten up on not only the credit scores and the way they're evaluated, but if in fact they have to add more capital, which most of them and everyone that I've spoken to has said it's absolutely ridiculous that they would have to add capital at this point. It would make it much more difficult, which is kind of what I'm hearing here this morning being reported back from the witnesses. Do you think that there would be a breaking point at which simply, we see either changes in inventory when it comes to single-family homes or small businesses that are starting to either relocate or are unable to expand after the pandemic that had such a devastating effect? What do you see kind of across the board as what that landscape would look like?
Sure. I mean, it's obviously complex, but basically if your required capital ratio goes up, you've got a choice. You can increase the numerator, raise capital, retain earnings, or you can decrease the denominator, and that means getting out of the types of loans that are attracting the highest risk weights, or the types of assets, and a lot of that is loans and particularly small business loans.
Very good, thank you. I yield back. Next, we're going to recognize Mr. Green from Texas for 5 minutes.
Thank you, Mr. Chairman. Thank the ranking member. Thank the witnesses for appearing today. I'd like to further introduce the witnesses by way of observation. It appears to me that we have but one female on this panel of witnesses. If you are a female, would you kindly extend your hand so that I may validate? But one hand, thank you. My vision is good. That appears to be Miss Philo, is that correct, ma'am?
Yes, sir.
My observation also indicates to me that all of the persons appear to be what I would call Anglo. We commonly in this country refer to people as white. I really don't like the term, to be quite honest. But if you have documented yourself as something other than white, would you, perhaps on the census, something other than white, would you extend a hand into the air? Let the record reflect that we have none of the persons who have documented themselves as someone other than a white person. I'm doing this, friends, because I happen to believe that there are people of color who can do what you do. But I could be wrong. So let me pick on you, Mr. Olmem. You have a storied career, by the way. I compliment you, sir. And your firm has done an outstanding job. I see November 17th of 2022, 53 lawyers made partner and counsel. And of that 53, this is fantastic, 55% of those promoted were female. That is fantastic. Your firm is doing a great job. I compliment you. Let the world know that I've said it.
Thank you.
And the greatest number of promotions were in banking and finance. Outstanding. Question is this, given your storied history, and I have one other comment about you. I am just absolutely impressed with your credentials. One other comment. The American Lawyer named you as one of their 2021 trailblazers, recognizing individuals who are agents of change in the legal industry. Agent of change, trailblazer. Are there women of color who can do what you do, sir?
Certainly.
And are there women of color who who can do what you do, my vision is not as good as I would like for it to be, but Mr. Baer.
Yes, I would agree, Congressman.
And our final witness, would you agree that there are women of color who can do this?
I would, and in fact, the immediate past chairman of the Mortgage Bankers Association was just such a woman of color and did a great job.
Thank you. I want to compliment all of you, but I must tell you, I'm a little bit disappointed that we have not arrived. We're not there yet, because for some reason, there are no people of color on this panel. And it's not your fault. So please, it's not personal as it relates to you. There has to be someone who will point these things out. If no one points them out, 50 years from now, we'll still have panels that are all white, no people of color. It appears that on my watch, I'm that person. I would ask this. Do you think that we should continue to have all white panels in a country where we have other persons who are capable, competent, and qualified and happen to be of color? If you think so, extend your hand. I'll make it easy for you. Extend your hand. Let the record reflect that no hands have gone up. Now, by the way, it was the Democrats that produced the one person who happens to be a female. So I compliment my Democratic colleagues and my Democratic ranking member for doing this. It's a bit late for you to answer this question, but Ms. Philo, I would have asked you, and perhaps you'll answer for the record, about these internal modeling that this takes place. And I want you to please explain for the record
Gentleman's
how
time
this
has expired.
complicates.
We'll allow the witness to answer the question.
How this, no, I'm asking her for the record, to how this complicates make the job of those who have to monitor banking. And Mr. Chairman, I'd like to, for the record, place into the record the article that I referenced related to Mr. Olmem's law firm, which has done an outstanding record, Mayor Brown. I want to put that in the record for you, sir, and I thank you.
It will be added to the record. And the gentleman's time has expired. We now recognize the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chairman. Thank you all for being here. I'm here batting at the bottom of the order, partially because I've been spending about the last 50 minutes with constituents from Georgia, part of our one of our counties, largest counties, chambers of commerce, and interesting enough, there was a lot of discussion regarding this matter right here and a lot of concern about the U.S. and the government in general, especially financial services sector, adopting international standards versus those that help and are designed and catered directly toward the U.S. industry. But I appreciate you all being here today. And in addition to the multitude of procedural material and sovereignty concerns that my colleagues and I have raised in letters, hearings, and discussions with regulators, I want to make it clear to the public that the Basel III proposed rule isn't some obscure regulation that only affects big banks. My colleagues and I are concerned that the 1,087-page Basel III proposed rule could tangibly increase the cost of capital, affecting businesses and homeowners nationwide. You've mostly answered a lot of the major concerns that I had, so I'm not going to go through a lot of those, especially when it affects the mortgages and MSRs. And but just Mr. Broeksmit, if just kind of encapsulating everything based on the answers you've given on several of these questions. Do you agree that borrowers would notice the effects of Basel III NPR's treatment of MSRs?
I do, and in fact, in 2011, just before the Basel agreements were put into place, banks serviced 91% of home mortgages. They now service 47%. If you make it even less attractive, they will service less.
What would be the alternative? Is it just we would see an impact in the real estate market? Were there alternative places to borrow money?
To be clear, there are plenty of other good players who service mortgages, and independent mortgage bankers do a great job servicing loans, from the consumer's perspective, the more sources of demand and sources of capital for mortgage servicing means the more valuable the asset. The more valuable the asset, the lower the mortgage rate, because the servicing value is an integral part of mortgage pricing.
Sounds like maybe competition tends to lower costs and
Competition
prices.
and choices for consumers, yes.
Exactly. I've shared with other people back when I served in the Air Force and the military. I was involved in intelligence, and the Soviet Union was our adversary. And one defector during that time ended up coming to the United States, someone from the Soviet military, and the first grocery store in the U.S. he went to, he was so amazed with the selection and the choices he had, he thought it was a setup by the CIA. And he said, who needs 12 different types of Raisin Bran? And so, again, choice is part of our economy. Last question for you on this. Do you think does the proposed rule contemplate the consumer confusion this would cause anywhere in the 1,087 pages? Have they addressed the confusion that this would bring up?
In addition to all of the other things they have not addressed to justify this rule, that is one of them.
All right, thank you for that. Turning to Mr. Olmem, was there broad consensus among the regulators on the NPR?
No, there wasn't. In fact, there was, I think, a record number of dissents at the board for a proposal, at least in recent memory, and there were 2 dissents at the FDIC.
Okay. And probably this is the last question I have time for. What should Congress take away from the reservations that several key banking regulators have expressed with the NPR? What should our reaction be? What should we do?
That there needs to be significantly more congressional oversight and involvement in this process, and that to remember that policy on capital regulation is really set here at Congress, and Congress needs to make sure that the regulators are following what Congress has already set out in federal law.
Do you see this as being something partisan, given that even people within this administration have expressed concerns?
It shouldn't be. Historically, capital regulation, if you go back, those statutes have been, for the large part, with kind of Dodd-Frank being the one exception, have been passed with significant bipartisan majorities. So it shouldn't be, and that's the danger.
All right, thank you, Mr. Chairman. With that, I yield back the 1 second that I had left.
Gentleman yields back. I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask the witnesses to please respond as promptly as you are able. This hearing is adjourned.
Thank you so much. I greatly appreciate it. It's a pleasure to meet you.